Hello, everyone. My name is Jake Bose. I'm the founder and fund manager of a firm called Crypto Yield Capital, based out of Houston and Miami. We run 4 DeFi yield-focused funds, but I'm super excited today. I think this will definitely be one of the most exciting panels of the day, in my opinion. But yeah, we'd love to give the chance for these guys to introduce themselves. They have extremely impressive backgrounds. We'll start here with Sean.
So I'm Sean Ford. I was one of the founders of Algorand back in 2017 with Steve Kokinos and Silvio McCallie. Built that L1 up. Have been in the sort of crypto digital asset space since then. Had a stint as the chairman of Napster, which was very exciting for 2 years. For those of you who are old enough to remember Napster, that was fun. And just been around the space working with a lot of folks. Spent a lot of time most recently doing delta neutral yield, sort of digital first products, and building a platform called Xe that does that with institutions and family offices. And just happy to be here.
Hello, everyone. My name is Carl Vogel. I'm a general partner at Six Man Ventures. We're an early stage crypto fund investing pre-seed through Series A. Our thesis has always been to invest at the application layer. We can build all the block space we want, but if nobody's using it, we're kind of kidding ourselves. That was a contrarian thesis and is now becoming more mainstream and consensus, which is exciting to see the market, in our view, maturing in that way.
My name is Rock Kopp. I'm a co-founder of EtherFi. EtherFi is a neobank built on Ethereum. We are basically trying to rebuild the banking solutions all on the crypto blockchain. So we're one of the 5th largest protocols on Ethereum. We have 3 different products: a staking product, liquid product, and then a credit card product. We have about $8 billion in TVL. Look forward to chatting.
Yeah, and real quick, I mean, these guys are being way too modest. I want to brag on each of them real quick. I mean, Rock, the #1 liquid restaking protocol for Ethereum, extremely impressive. I mean, over $6 billion in TVL, making a ton of revenue. I mean, Carl, I mean, their fund's backed by Bill Ackman, $125 million. They've invested in so many amazing products. We all know my favorite being Pump.Fun. Just super impressive. And then Sean here, being super modest, was one of the co-founders of Algorand, and is building an insanely impressive synthetic dollar on Avalanche with Xe. And so I'm just super excited to be up here with you guys. And so I just want to jump right into this. We see all the time in DeFi, all these metrics: TVL users, monthly active users, daily active users, really whatever looks the best for your protocol. So I want to start just with asking each of you, if you could kill one metric that is used in this space, which one would you choose and why? And Sean, I'll start with you.
I would kill TVL. I would absolutely. I think I mentioned this earlier. I was talking, and I said that we need a Noah's Ark moment for metrics in crypto. Just clean it all out and start from scratch. The reason, from my perspective, is that, and we could talk more about this. I'll keep this quick. It's highly manipulatable. It is creates perverse incentives for projects to inflate, because investors, it's the first question you get: how much TVL do you have? It's a gating mechanism for large capital holders. So even the people you'd think would be sophisticated, they want to see a certain number before they, quote, trust you. So we're in this strange place where, in my mind, TVL has led many people down very broken paths and ruined a number of very good projects that maybe had some upside potential, but weren't willing to sell their soul to fabricate bullshit in order to get the attention of people who might give them money. So TVL, you can tell I'm not a huge fan, but I'll stop there.
I agree with TVL as #1, and to build on that point, it's about, like, traditional markets are about capital efficiency, and TVL, if you have billions of dollars just sitting there idle, that capital requires some sort of return. And if it's not coming from actual fees or revenue generated by the platform, it's going to come from token incentives. And so basically now you have mercenary capital coming in purely for a token, and then when you give them that token, they're going to sell it and move on to the next thing, or they can go ahead and get a higher return. So fundamentally, TVL is by far the worst thing. We should be focusing on capital efficiency, not TVL. But to add a new one, just so we don't all say TVL, because I think we probably all agree, I'd say Twitter followers or like social metrics. The amount of teams that like immediately say we have 50,000 Twitter followers, it's like the most garbage. I almost like immediately write off the project.
It's a red flag.
Huge red flag, not serious. I'd rather have 100 loyal users that are constantly bull posting this than 10,000 Twitter followers when I look at a deal.
And sorry, Rock, real quick, I want to give you a chance to say anything, but Rock, Carl mentioned mercenary capital. I'm sure you guys have had to deal with that other fight. Could you discuss that a little bit? Because what I found fascinating about you guys is you're running this points program, and you saw TVL increase, it was doing extremely well. Then the points program stopped, but TVL is at an all-time high on net terms right now. So how did you guys, get across that bridge?
Yeah, so we have 197,000 Twitter followers. I'm just kidding.
You've just been written off.
This is one of the hardest things. So TVL, it is a metric that people pay attention to, and it's totally vanity, right? Because a lot of people pay for the capital. There's ways you can manipulate it, and it might not be profitable. So we come from the Web 2 space and have been startup founders in the Web 2 space. So we were focused on things like CAC, ARPU, like these terms that make sense for investing in traditional markets. So we've always been focused on profitability. And you kind of have to play the TVL game and the points program game to get users. It actually really helps with distribution and allows you to grow super fast. So that helped us a bunch. When we did the points, we got 300, 400,000 wallets into the protocol, and we were kind of riding this wave. So much of crypto is about narratives, and so we kind of caught a narrative well. We were doing it, but our thesis was always that you had to vertically integrate. And what I mean by that is you need to stack products on top of each other. So you get a user in, but you need to get them using more than one thing. In so many crypto projects are in for one thing. You get this large valuation, and then the team starts to sell off tokens, and they exit stage left. For us, this was never about money. We actually think that crypto can change how we interact, and it can be a legacy, right, of how finance happens. And so that was really our focus, was how do you build a long-term sustainable business. And so I am happy to say we're profitable. We've been profitable for 2 years. We do $50 million in revenue last year. Really good growth. Like if someone would see our accounting statements and we didn't tell them we were in crypto, they'd be like, it's a really good business. But there's a lot of negative connotation just around crypto. So I actually think it's the biggest thing to get more capital into the space is to create really good businesses that are generating cash flows to bring more capital in the space.
Absolutely, and it seems like the whole concept of getting sticky TVL, it's got to be extremely difficult. So Sean, when you were at Algorand, you guys were in a $300 million incentives program. From doing all of that, what did you learn, and how are you applying it to XE now?
I think so. That's a little bit. It's a little bit apples and oranges. But what I would say is that what we learned, what I know that we're doing now is you can't cut corners. You can't start putting up flashy, numbers that you've inflated in order to attract interest. Fundamentally, to Rock's point, you've got to focus on building a real business and a profitable business that has a line of sight into sustainability and positive revenue and profit. These are super boring things. Like this is standard. This is business school 101. Unfortunately, the vast majority of the crypto market still are people that like to play at casinos. They look for the 100x. They're trying to pick the right token. They're not particularly sophisticated. Now, it doesn't mean that they're unintelligent, so I want to clarify, there's a lot of smart people, but they're not sophisticated in terms of how they assess value, how they assess quality. And, so at Algorand, I think the point was where we took hits was we really were ahead of ourselves in a number of ways, where we over-rotated towards the quality of the tech. We over-rotated towards what we thought would be real-world assets and equities being issued. Exodus was one of the first ever, and they issued on Algorand, and it was just too far ahead of the market. But I do think that if you have to bolster your relevance with incentive programs, it's okay for a period of time, but it won't be sustainable, and ultimately it's going to hurt you in the end.
Yeah, Sean, you mentioned sustainability. Carl, I have a question for you on so Pump Fund, one of my favorite protocols. I mean, incredible metrics, over $1 billion in revenue. I mean, one of the most exciting crypto projects out there. When you guys are evaluating businesses like this, how do you determine, what makes these projects sustainable, and what about the tech? How can you differentiate, say, this is a good tech investment versus this is a good business investment?
I'll start with the second question. I think with the sort of growth of Claude Code and the ability for anybody to build anything, the tech and like the moats around technology that we have a giga, Chad group of engineers building this actually becomes less important. If you're building high performance, blockchains or other applications, it's still very important. But we do a lot of consumer investments, and a lot of it is, can you crack the human loop and psychology to go ahead and get those users to just be addicted to your product? And now anybody can spin up an app in 24 hours to start to validate certain sets of hypotheses. So what I look for now is not as much, is this person an engineering savant? It's do they understand humans and what humans want? And to your point, people want 100Xs. And so there's a huge part of society that sees this and their ability to understand emotions and the ability to create interesting growth hacks as the winning formula. And so increasingly we're looking more and more towards that as the staple of what is going to be a sustainable and successful business. On the sustainability, it really comes down to market size. I think there's a lot of teams that have great ideas and the markets are way too small. So if you don't really get customers on board and they churn, there's actually not that many customers that you need to, that you can go through before you've sort of exhausted the market. Also, a lot of these products, the churn is just very high. And so generally it's about the human psychology, and I guess, let me wrap there. I'll pause there.
Yeah, no, that's super helpful. And I know we've talked about revenue. So Rock, I know you guys mentioned you did $50 million in revenue last year. For someone coming from TradFi like myself, what is, it sounds like a basic question, but what is revenue in crypto? What does that mean? And if I buy a token, say EtherFi or whatever it is, how does that work?
That's a good question. So it just one comment on the other point too. I think distribution is so important, and that's the projects that will win. Whoever has the best distribution, because tech moats are just being taken away. And so distribution is super, super important. As far as revenue, for us, that's US dollars that we denominate in. Some of our revenues come in ETH, some of it comes in Bitcoin. We always denominate back to US dollars, and we'll hedge. If we get returns in ETH, we'll hedge against that and get it into US dollars. So we still have a bunch of ETH on our balance sheet, a bunch of Bitcoin on our balance sheet. We're long crypto, but I think it's pretty irresponsible to just have it fully denominated in that. And so we do focus on US dollars. For our products and how they come, so our biggest product is Ethereum staking. Basically, we just get 15 basis points that come in for whatever assets are staked. On our liquid vaults, which is, it's basically, I call them ETFs or mutual funds in crypto. They're managed strategies within DeFi. We get 100 bips off that. And then our credit card, we get 140 bips of revenue. So it's you can turn crypto stuff into very normal revenue balance sheet stuff, but a lot of that's not there. So one of the key things I think actually for crypto, and it's increasing the market size. So much of the crypto market is focused on the casino right now, and that is the product market fit of crypto, is a casino that's open 24/7. We need to build really good consumer apps and get more people into it, and so it's what we're doing. And our app has been very successful, but we have 70,000 active cards. There's 6 billion people in the world, right? We're just scratching the surface. The exciting thing is our addressable market is massive. It's the world. We can move a lot faster because we don't take custody of the funds. But people are still scared of crypto. People aren't going to put $1 million on their hardware wallet. They'd rather keep it at their Chase Bank because that is more safe to them. So it's kind of making crypto more safe in building these really great consumer apps that I think brings the next scale of revenue to the market.
No, that's awesome. And kind of to piggyback off that, Sean, I have a question for you. It sounds like you guys have had a lot of success so far with actually getting involved with institutions, raising money. It's been phenomenal. you guys are running a points program right now, correct? Points program. And so it sounds like, yeah, eventually you will have a token. How are you guys thinking about, balancing the needs of, users using the protocol, let's say retail, versus investors in the protocol?
So if I might, I'd like to step back just one step and say that the premise that I'm operating under and that we're operating under with what we're doing is that the market, like every other new industry, always moves from speculation to substance, always. If you look at the gold rush, the land rush, the oil rush, the early days of the internet, it was full of absolute garbage. It was people saying, gold in them thar hills, go west to make your fortune, you have free land, and it was chaos, and it was absolute manipulation. You even had people driving through town saying they had the cure to everything that ails you, and essentially it was cocaine. They gave people coke, and that's what they did, and you felt better, and then you felt worse. So like that's what happened with almost every single market. We are at a point in crypto where I think the shine on the casino is dying. And we're still, however, defined as successful based on the old records playing high returns that were casino driven, or the success stories of the instant millionaire. You take that where we are and you combine it with what I think is more and more institutional capital holders are crypto curious, are getting involved. There's evidence everywhere. JP Morgan, there's ETFs, there's people that are talking about deploying at least 5% of your portfolio into crypto assets. What does that mean? That doesn't mean, yay, we can still go to the casino and there's going to be more money. No, it means the casino money is going to be gone. And what it means is that institutional capital is going to come in with adults that are going to be looking for real metrics, look for real rigor, and real ways to evaluate projects. So crypto projects, do better. Investors, do better. Do better. It's bullshit to ask people about TVL if you're an investor and think that's the magic bullet, because that means you're not sophisticated, to be honest with you. That's what it ends up being. And I would say, there's a lot of smart investors. The last thing I'll say is, Sequoia invested in FTX. And everybody at FTX, for those of you who weren't in the middle of it, it was, there's savants over there. Just trust me. And a lot of really smart investors put an awful lot of money into that thing, and they did not do their due diligence. So I'm just saying that we as an industry need to step up our game and stop acting like we're going to go to the casino and win at the roulette wheel, and start building real businesses with transparent metrics that people can actually rely on and judge.
I think it's both and.
And seen.
I mean, if you look at every single trend, financialization is increasing. The younger generation in particular is gambling more than any other generation previously. So these markets are going to keep growing. And I think as the economic wage gap continues to grow, increasingly people are going to be looking at speculation and gambling as their only source of financial freedom. Do I think that's good for humanity? No. But my point is it's both and. I think the speculation is actually good, and crypto is the perfect speculation layer to exist because you have instant settlement, no counterparty risk, all these things that traditional online casinos suffered from, you no longer suffer from in crypto. But I also am excited about the real world use cases and adoption that's coming on chain, like the DeFi mullet that I think you guys are pioneering really with the credit card. It's a primitive users understand, but now it's backed by crypto. You look at what Coinbase is doing with Morpho, now offering higher yields to retail that they can't get otherwise. So I think it's both and. Like the market's growing, and speculation will keep growing. On-chain yield will keep growing. Tokenized equities will hopefully keep growing. Like there's so much ahead of us, so it's pretty optimistic looking forward.
The one thing I'll say too, price drives narrative so much in crypto, and so like Bitcoin's down 40% or whatever, and like people are just crushed. But if you take a step back and actually like look at what is going on, I've never felt better about crypto than I do now, and all the institutions are building there. My thesis on this last drop is there's just OG capital used to be able to manipulate the market a little better, and there's sharper capital in there now, so they can't do it as much, and that hurts, right? So you see a lot of OG crypto people who maybe took some losses on this last dip that they thought they could have shot it up, and that hurts. But again, the casino, there's going to be winners and losers, and that is the use case that got people in. People will gamble. That's the reality. But I do agree you need to build apps that actually bring utility to people on a real world basis.
I would just like there to be greater balance. I don't mind there being speculators, but when it's 80% of the market, and ironically, blockchain was supposed to be eliminate the need for trust, or it was all about that. And we've concocted an industry that uses metrics that lead people to make decisions that are that actually erodes trust in the quality of projects.
Yeah, so we've talked a lot about like which metrics are unfavorable, but so which metrics do matter to you guys? Like, what are you actually looking for? Are there metrics that we should be creating that would be more helpful?
Are you talking from like an investor's lens, or?
Yeah, and so someone from like myself, I mean, we're constantly looking at like where's the real value in this space and how can we capitalize on it, right? So, and I know Carl, you guys do tons of investing, obviously. Like, what metrics are you guys looking for that have resulted in success in a lot of your projects you invest in?
It's sustained money. I mean, like everyone's trying to get your money these days, and if you can have a customer that doesn't churn and every week they're coming to your product and giving you money, and you're growing that, both like the number of users and the amount of revenue over time, like that's like actually the most important thing. It all comes down to that. It's like very, very simple. Obviously, you can make it really complex, but if you can get, if I'm building a product and I can get you, and then I get you, and I get you, and they're all giving me money to interact with my platform, that's the winning formula. And then you can just keep scaling the market.
And I know, Rock, I know you guys are doing buybacks as part of your strategy. What goes into that decision versus distributing out cash? Like, how do you decide from a treasury management perspective? I would love to hear about.
Yeah, the token is a very difficult thing to navigate just because of the lack of clarity, I guess, that we have on it. We want to follow like every rule and be above board. So like we're trying to, there's just not a lot of guidance. And so you have to be kind of careful with what you're doing there. We do a buyback. So we committed to buying back $50 million of the token over 12 months. We talked about this a bit before, but a lot of capital in crypto is mercenary. And so your early investors are sometimes just exiting, and so that buyback is just going to capital that's going to exit. A normal VC investment is 7 to 10 years. In crypto, it can be 1 to 3 years, right? Like where people are getting returns, kind of crazy. And so it's the shifting of hands to more stable capital that's kind of like in believing in a long-term vision. So we don't know what the right thing to do is with the token. Honestly, what we're focused on is building a profitable, sustainable business, and we'll figure out the token stuff. Like that will come, I think, with clarity.
Do you think if clarity passes, you'll switch from buybacks to another revenue distribution mechanism?
I don't know. So is my answer. I don't know what the market will like. So currently we're doing 50 million of buybacks, and then if you stake your ETHFi, you get 10% APY, right? So in our FTVs, we'll call it 500 million. So it's like effectively a 20% APY, with the buybacks and the staking. We can't be that outgoing with that. I don't know. We're kind of seeing how the market goes, and I don't think there's like a great formula of anything that works particularly well right now. But you invest, so it's like I'm more curious on the liquid side. Like, what do people look for? Because like we're trying to figure out. I think both sides, investors and protocols, are trying to figure out like what that is.
It should be aligned, though. I mean, the things that the companies are working towards should technically align with what investors perceive would create value, right? If I was going to be real specific, I'd look for a new version of TVL that would be, there's papers out there on redeemable value, right? So essentially it's unlevered TVL, so a real number there. I think capital diversification is super important if you're looking at projects that manage capital, meaning that if you've got 3/4 of your capital is mercenary and they're going to be there for 3 months and then dump it the second either there's something in the market or their lockup expires, you could show 100 million TVL, but you really might only have 15 million or 10 million in that scenario. So you like you would if you had a traditional software business, how risky is your revenue? How diversified? You have to look at how diversified the capital is. And then I think the last thing is unique users or unique adopters, right? It doesn't have to be retail only. It could be number of wallets is always good, but again, you have to get down to the sort of real number. I always go back to usage, virality, and stickiness. Those are the 3 meta categories you can evaluate almost any project with, and it translates very easily over to a lot of crypto projects as well.
I think software metrics will come to cryptos,
I agree with you.
Right? So like the metric that we focus on is the ARPU, which is average revenue per user. We're at $300 per user. They come in, and we know we get about $300. So it's like okay, keep acquiring users. We have multiple products to get them in. We know it's about $300. Our payback period on that. So it's like, okay, if we can spend up to $300 to get someone back. If we can pay ourselves back in 1 year, we'll take that person. Because our churn is also positive, just because of the different products we get them in. So it's going to be that users, churn, CAC, all those things are going to come into play.
Phenomenal, guys. Well, I really appreciate all of your time up here, guys. What an amazing panel. That's all the time we got, but
Great
thank
job.
you.
Thank you.
Thanks.